Big gains feel amazing, right up until the IRS shows up. You open your brokerage app, your portfolio is up 6 figures, maybe 7. You finally hit sell, adrenaline still buzzing, and then reality lands. An email from your accountant. Congrats, also, you owe a lot in taxes. Meanwhile, you watch wealthy investors sell massive stock positions, fund new ventures, buy real estate, and somehow walk away with tiny tax bills. Same market, same stocks, same laws. So what are they doing differently? Here's the uncomfortable truth most people never hear. The rich don't win by hiding money, they win by planning. This isn't tax evasion, that's illegal and dumb. This is tax avoidance, using the rules exactly as written. And the best part? Some of the most powerful strategies they use are available to anyone. Most people think taxes are something you deal with after you make money. The wealthy know that's backwards. Taxes are a design problem, not a surprise, because once you sell a stock in the wrong place at the wrong time in the wrong account, the damage is already done. So instead of asking, how do I pay less tax now, they ask, where should this asset live before it explodes in value? That single question changes everything. Let's start with the strategy that feels almost unfair. Imagine you own $5 million worth of stock. If you sell, you trigger capital gains taxes, possibly hundreds of thousands of dollars gone instantly. But instead, you don't sell. You pledge the stock as collateral and take out a loan. From the IRS's perspective, nothing happened. You still own the shares. A loan is not income. No taxable event occurred. You get cash, you keep your investment, your money stays compounding. Now, this isn't magic. There's interest, markets can fall, margin calls are real. But here's why the math often works. The interest rate on these loans is frequently far lower than the tax rate you'd pay by selling. So wealthy investors compare two numbers. What would I lose to taxes? What would I pay in interest? And they choose the cheaper option. This is one reason you see the ultra-wealthy living off loans while their portfolios quietly grow in the background. At this point, a lot of people think, yeah, but that's for rich people. Here's where the story flips, because the most powerful tax strategy isn't borrowing, it's where you put your investments from day one. Let's talk about accounts where the IRS never touches your gains. The Roth IRA. Anyone with earned income can open one. You can invest as little as $1 or as much as $7,500 per year for 2026 and up to $8,600 per year if you're age 50 or older. Inside a Roth IRA, your money grows tax-free. Your dividends grow tax-free. And when you sell in retirement, the gains are tax-free. Read that again. You can sell stocks and owe the IRS $0 on the gains. And this is where the math quietly creates millionaires. If you invested $625 a month, the annual max, into a simple index fund earning the historical average of about 10% per year, after 28 years, you'd be a millionaire. Even starting with just $100 a month at age 18 can grow into over $1 million by age 65. And when you sell, no capital gains tax. The wealthy don't ignore Roth accounts. They prioritize them.
Now, what if you make too much money for a Roth IRA? This is where things get interesting. High earners are often told they can't contribute to a Roth. That's not exactly true. They use something called a backdoor Roth IRA. Here's the simple version. You contribute to a traditional IRA, then convert it to a Roth. You pay taxes only on what hasn't already been taxed. It's legal. It's common, and it's how many high-income households quietly build massive pools of tax-free money. Then there's the Roth 401k. Many employers offer this option, and most people ignore it. Same idea. You pay taxes now, your investments grow tax-free. Withdrawals later are tax-free. Unlike a Roth IRA, the contribution limits are much higher. For people early in their careers or anyone who expects taxes to be higher later, this can be an incredibly powerful move. And then there's the most underrated account in America, the HSA. The health savings account has something called triple tax advantage. You get a tax deduction when you contribute, Your money grows tax-free, and withdrawals for qualified medical expenses are tax-free. Wealthy investors often treat HSAs like stealth retirement accounts. They pay medical expenses out of pocket, let the HSA grow invested, and reimburse themselves years or even decades later, completely tax-free. Now let's talk about timing. Stocks held for less than a year are taxed as ordinary income. Stocks held longer than a year qualify for long-term capital gains, which are taxed at much lower rates. That difference can be massive. If a wealthy investor is 10 months into a huge position, they're not guessing. They're calculating whether waiting 60 more days saves them 6 figures. Patience isn't just emotional discipline, it's financial math. When markets fall, most people panic. Wealthy investors get strategic. They harvest losses on purpose. They sell positions that are down to offset gains elsewhere. They reduce their taxable income. They carry unused losses forward into future years. It's not about predicting markets. It's about using volatility instead of fearing it. And then there's one strategy most people never think about until it's too late. Location. Where you live matters. Some states take a huge cut of investment gains. Others take none. For someone realizing a multi-million-dollar gain, moving from a high-tax state to a no-income tax state can save more than most people earn in a lifetime. This isn't something you do casually. It's a life decision first and a tax decision second, but it's very real. So let's put a face on this. Meet Alex. Alex builds wealth over decades. Some investments go into a Roth, some go into a 401k, some go into a taxable brokerage account. When Alex needs cash, he doesn't panic sell. He borrows strategically, harvests losses during downturns, waits for long-term capital gains treatment, and sells inside tax-free accounts whenever possible. Does Alex avoid all taxes? No. There's interest, there are fees, there are still taxes out. But compared to selling everything at once and writing a massive check to the IRS, Alex keeps more money invested, more time compounding, and more control.
And this is the real secret. This isn't about loopholes. It's about timing, placement, and patience. The tax code rewards long-term thinking. It rewards planning ahead. And it rewards people who use the accounts that already exist. You don't need to be rich to start doing this. You need to start before you're rich. Because once the gain happens, your options shrink. Making money in the market is hard. Keeping it is harder. The wealthy don't avoid taxes by cheating the system. They avoid them by understanding it earlier than everyone else. So start where you are. Open the accounts, play the long game. Let time do the heavy lifting. Because the real flex isn't how big your portfolio gets. It's how much of it you actually get to keep.